Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. Trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. His website's PIFinancial.com and PolarFuturesGroup.com. Welcome back to the show, Drew.
Thanks for having me on again, Jim.
Drew, the famous saying, sell in May and go away, did it hold up this month?
Yeah, did it ever. We had the U.S. equity markets off about 7% through the month of May and down just continually, almost each and every day as the markets reassessed the negative turn in the U.S.-China trade war or trade issue, whichever you'd like to call it. And then at the end of the month, we also got the more surprise Trump tweets about tariffs going on to Mexico that will start at the beginning of June at 5% and ratchet all the way up to 25% by October. So really taking the whole tariff game to an extreme level. I think definitely put a little bit more fear in the marketplace. And on that, we had stocks just continually move lower until today. Today we had a very strong move in the market. So I'm thinking it was more than just the regular sell in May, it's going to get sleepy in the summer, and you don't want to be holding on to equities because they won't go anywhere anyways, sort of an environment. There's just too much going on right now in the macro space with the economic numbers that we have coming in. I continue to look at not only American PMI numbers, that's a good forward-looking economic indicator. On the manufacturing side, continues to slow. It's slowing globally. It's slowing in China. It's been in contraction territory in Germany, a big export nation in the European Union for several months. So there's a lot more to the global slowing story than, just what Trump has decided to do. But what Trump is doing is exacerbating that issue. And I think that's part of what we saw get realized through the month of May.
Mm-hmm. Europeans as well being very concerned. Is it a case of, with negative interest rates in Europe and Japan, they're moving their money into North America because they don't see any alternative? And is that holding or propping up the markets?
Yeah, I think it had been that way on a number of occasions, as you can get a bit of a self-fulfilling cycle going. So if you're a saver and you need to put your money into safer instruments, such as government securities, sovereign securities, and you can get 0 or slightly better than 0 in much of Europe, or, at one point we were getting 3.25% on the U.S. 10-year, down to 2.1% now. So still, even after that huge drop in the U.S. 10-year rate, Germany's negative at the 10-year rate, almost 20 basis points negative. So you're still getting a huge pickup. So I was seeing flows into the U.S. for that. You were seeing that with the U.S. dollar index at 2-year highs. So there is a bid into the U.S. dollar. And because you have rates at the same time coming down in the U.S., getting closer to global rates, you are seeing people get pushed out the risk curve, and I think that really pushes you into the equity market. That pushes you to, try and get a stronger dividend if you need to have that sort of income generating portfolio. So it did bring money to America, and then at the same time, as American rates started to come down, I think it pushed people further out the risk curve. And even while that was happening, we still had equity markets, had rocketed higher in the first 4 months of this year, and then we're coming back in May, despite the fact that the U.S. dollar was going up and rates were still going down. So I do think there is a good argument to say that U.S. rates being so much higher than the rest of the world will continue to keep a bid in the U.S. dollar to some degree, whether that's, at these 2-year high levels, or higher. But I'm still skeptical of the relationship between stocks and bonds, that we've seen over the last year, especially. When we went through last fall, stocks fell dramatically and bonds rose, and then as stocks rocketed back up in the first 4 months of this year, we didn't have that same move in the bond market. That is to say that yields stayed a lot lower. We didn't see the U.S. 10-year jump back to 3.25% through the first part of this year, and that's because the market's expectations of what the Fed has to do. And then I think you really need to look at it and say, if you're pricing in Fed rate cuts, is that because you think the economy is strong and you want to be in equities, or is that because the global economy is slowing? And I think that's going to be the big question going forward.
Have we had enough of a pullback that the market's going to increase again, or are more declines expected?
Well, I think today was a great example of, maybe the last month was a little bit of a sobering up of markets to the economic reality, and we saw, not a lot of panic selling, but just gradual declines day in and day out in the stock market. And then today we got maybe a bit of hope that the USMexico tariffs, could be resolved possibly even before they go into effect. There's going to be some trade talks there going on in Washington tomorrow. And then we also had a lot of Fed speakers out today where they hinted or alluded to the fact that they were, watching markets. And then when equities started to rally, they really started to rally some more. So it was almost a hope of further rate cuts. But again, I would say that's already priced into the bond market. There's over an 80% chance already priced into the bond market that we're going to have 2 rate cuts by December of this year. So it's almost like it was the hope of that has given us this sort of a slingshot rally on a daily basis that I think might be overdone, given that it's already priced into the bond side of things. So, if equities were to stay up here, or move back towards the all-time highs, then you've got to start pricing out the rate cuts. And in order to do that, then I think, equities kind of give back some of this, Fed-inspired rally that they've had. So for me, as we're, say within 5% of the all-time highs, 7% of the all-time highs, the risk-reward in the equity market almost caps itself in the fact that if it does start to do better, the motivation for having it run up like it did today gets pulled away from it. So I still think that's the risk reward at these levels, 2,800, 2,900 on the S&P, are very risky over the medium term basis.
We'll have more with Drew Zimmerman right after the break.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Drew Zimmerman. Drew, if the Fed is expected to cut rates, will that help the equity markets?
Again, the expectation has already been priced in. So if they do cut rates, I think, you might see a short-term rally, but again, the fact that it's already priced in, it would be hard to maybe see that, have a big impact. And a great example was last night we had the Australian Central Bank cut interest rates. So they went from 1.5% to 1.25%. And the currency actually appreciated on the day. So normally you'd see a central bank cutting rates, the currency would depreciate, especially when you say, as the Australian Central Bank did, that they could cut rates further. But again, when the market is fully expecting something, you've already priced it in. So are we there with the bond market? I think so. Today, obviously, the stock market was showing a little bit more exuberance on the hope or the higher likelihood that we were going to get rate cuts, or the fact that we were maybe going to get more rate cuts out of the Fed than had been priced in previously. Has that gone too far? Have we priced in almost all the good things rate cuts could bring? I mean, we haven't priced in rates going to zero yet, but we're starting to price in more and more rate cuts all the time, and that's still only got the equity market, the S&P, back to 2,800. I think the rate cut aspect of this market is giving it less and less as we go forward. And again, if it were to do better from here, I think that, pulls the wind out of its own sails, so to speak, and creates some risks. So I think there's still more geopolitical risk on the trade front, and then more importantly, I think some of the economic numbers continue to come in softer. So I think the Fed is going to find, their hint or their alluding to that they are willing to cut rates, will have less and less of an impact on the stock market. But we'll see, because again, today was a very strong day with the equity market up over 2% today.
The Mexican president said tariff threats or not, he's going to continue to talk trade. Also, the new NAFTA has to be ratified. You start putting new tariffs on, aren't you kind of shooting yourself in the foot if you want the trade deal to be approved?
Yeah, there was a lot of issues that arose from those surprise tweets from President Trump saying that those tariffs would be going into effect, and it's almost using tariffs as a trade measure, and now he's using the tariffs. The main sticking point for him with Mexico seemed to be more immigration based. So you're seeing him use the tariff tool for more than one issue that he sees facing the United States. So there's a big impact, I think, not only just for the U.S. and Mexico with this new tariff announcement, but also just trade within North America. As we all sort of forgot about the USMCA, but at the same time, and especially after the steel aluminum tariffs came off, we thought it was maybe all but done. But now it's looking, further and further from actually getting finished. So I think there's still a ton of uncertainty, not only with the U.S.-Mexico tariff issue. I mean, again, it was sort of an announcement that they were going to have trade talks. We saw how well that went. I mean, it dragged on for months and months and months before it finally fell apart between U.S. and China. And now, again, they're trying to put some headlines out that maybe some trade talks will progress on the U.S.-China front as well. But again, you're seeing how difficult these things are to actually get from start to finish, and the market seems to really love to grab onto a headline and run with it. But as Canadians know, we were over a year talking about NAFTA before it was even renamed the USMCA, and the amount of uncertainty that caused Canadian businesses, especially Canadian export businesses, the lack of money that gets put back into CapEx that, again, just feeds back into the slowing global economic picture that we're seeing right now, tells me that as much as you see these short-term rallies in the equity markets, you've really got to focus on, is this going to get done over the next, several months or even year? If not, or if it's going to drag its feet like we've seen, that slowing really trickles through the rest of the economy more than you would think.
Well, Parliament in Canada is going to be shutting down for the summer. Then we have a federal election in October, so not much business is going to get done there. The U.S. federal election next year. There's a really tiny window to get business done.
Yeah, I mean, that's the whole other aspect of it is the political landscape that we have both in Canada and the United States, with coming elections sooner in Canada. It really does narrow the window and again lower my expectation or hope that we do push some of these things through that, again, we'd kind of maybe thought were more completed. And again, that's always, wait until the chickens have hatched to count them. But I think it's a tough global environment right now, and you see, different countries sort of willing to dig in into their positions to some degree, and maybe that's not what we need right now, but that's what we've got. So I think you have to assume that things are going to stay more volatile, and less conciliatory in the near term. And to me, that's more uncertainty and more likely to be equity weakness. It's more likely to be, central banks that are more cautious. So that usually means rates are going to go lower. And when you see rates going lower, that's not a strengthening economy. That's not one that I really want to bet on global growth.
We'll have more with Drew Zimmerman right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, is more attention being paid to rare earths with China threatening to cut off the supply to the U.S.?
Yeah, rare earths. I mean, again, it seems to be being brought in as a bargaining chip in an ongoing dispute between two countries. Obviously, the U.S. was able to up tariffs on more imports. That option wasn't there for China, so they're looking at different options which they can use. So, again, I don't think anything's sort of off the table where any country feels like they have an edge or can, push the other country to some degree to hopefully sway them or again, impact, their big companies that can then in turn sort of lobby, the government. So I think it will continue, to be an issue. I mean, the rare earths are important in a lot of our, modern day, appliances and electronics that we're using. So, we can't go without them. And, if things start to get more expensive, again, it's all going to be maybe how business and consumers start to apply pressure politically, to enact change. And I think that's sort of the ultimate goal there. But, again, it's sort of one thing in a bigger argument that's going on at the moment, to my mind.
Right. Now, of course, there are sources for rare earths outside of China. The problem being that you have to use sulfuric acid and other harsh chemicals to process it. There's a huge social cost when it comes to the environment around the places that it's processed. So you may have a source for rare earths, but nobody wants to process it. You also get radioactive waste from it. So even if you start producing rare earths, the people who live in the area may not like you for it. China's willing to take the risk?
Yeah, it's already happening. So again, anytime you're disrupting a current supply chain system, there's going to be added costs. There's going to be new stakeholders that don't like it. It's moving any sort of a mining field. Nobody ever wants the anything bad in their own backyard. So anytime you disrupt what's already working and in motion, you get a fairly stiff resistance to it, and I think that's sort of what they're banking on.
What's your outlook for gold in the near term after the sharp move higher the past couple of days?
Yeah, I've been watching gold closely. To me, I always keep two key drivers in mind when I look at the gold price. That's what are real rates doing? So where are our interest rates minus inflation, and what is the U.S. dollar doing? So as I'd mentioned earlier, with the U.S. dollar pushing to 2-year highs, the U.S. dollar, I think, had been doing a good job of keeping gold prices lower, while at the same time, real rates were going lower, which should have been helping gold prices do better. So when we finally saw some weakness here the last couple of days in the U.S. dollar, gold was able to jump significantly. I mean, we had from the lows to the highs about a $50 move in 3 days in the price of gold. That had come off of sort of a 1270 level of support that's held up for about the last month. So even though we had a stronger U.S. dollar, gold was really doing a pretty good job of holding in at that 1270 level. I think this strong break above 1300 shows some pretty good strength in the gold market. I'm still biased to think that we're going to see more U.S. dollar strength, especially if we see some risk-on trade come back later on this month. That's equities heading lower. So in that environment, I don't know that gold explodes to the upside, but to me, if we saw the U.S. dollar move higher and gold sort of come back down and test this 1280, 1300 level and still hold in well with a stronger U.S. dollar, that's the dollar index, say, retesting the highs of a couple of years ago at 103, 104 on the dollar index, then, that's a great buying opportunity for gold, because if it's holding up that well, in the face of such a strong U.S. dollar, then any further weakness in the U.S. dollar, and I think gold could do a lot better. And again, just with the sort of global economic situation slowing, the ongoing global trade disputes, I think there's a lot of good reasons to be owning gold. I've been watching it closely and missed this breakout, and I can kick myself a little bit for that one. But at the same time, I don't want to be chasing it. So, given that I'm looking for some more strength in the U.S. dollar, if we see a retest level on gold, I'll be looking to try and get a long position in, because I really do see the possibility of a multi-year move in gold. So we'll try and pick our spots as we always do. But I think gold is looking quite good, and I see a lot of technical and fundamental reasons why it could be a good play for quite a while.
Drew, thank you so much for chatting with us.
Thanks for having me on again. I appreciate it.
My guest has been Drew Zimmerman, portfolio manager at PI Financial in Vancouver. His websites pifinancial.com and polarfuturesgroup.com. If you have any questions for Drew or any of our other guests, you can send them to info@housestreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HouseStreet. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.